2.9%. That single number, released yesterday by the Bureau of Labor Statistics, just detonated a chain reaction across every precious metals market on the planet. Silver dropped to $84 an ounce. Gold slid below $5,000. The dollar surged. And if you're watching mainstream financial coverage right now, they're telling you this is the beginning of the end for silver's historic run. They're wrong. Not because the data isn't real. It is. But because they're reading the scoreboard while completely missing the game being played underneath it. Here's what actually happened. January's consumer price index came in at 2.9% year over year, up from 2.7% in December. Core inflation, the number the Federal Reserve obsesses over, ticked up to 2.7%. Energy prices climbed. Food prices climbed. And the immediate translation Wall Street gave you was simple. The Fed won't cut rates. The dollar gets stronger. Silver gets crushed. End of story. Except it's not the end of the story. It's not even the interesting part of the story. Because sitting directly behind this inflation print is something far more consequential. A structural collision between monetary policy, physical commodity scarcity, and a new Federal Reserve chairman who hasn't even taken the seat yet. Kevin Warsh. The man Donald Trump nominated on January 30th to replace Jerome Powell, a former Fed governor with a reputation as an inflation hawk. The markets saw his name and dumped 31% off silver's price in a single trading session, the worst day for silver since 1980. And now, with CPI confirming that inflation is reaccelerating, the assumption hardening across trading floors is that Warsh will keep rates elevated, the dollar will stay strong, and silver's rally is finished. That assumption is the trap. Because what the CPI headline conceals is a paradox that nobody on financial television is explaining. The very inflation that's supposed to kill silver is being driven by the same forces that guarantee silver is structural demand for the next decade. Energy costs are rising because the global economy is electrifying, and electrification requires silver. Food costs are rising partly because supply chains are fracturing along geopolitical fault lines. The same fault lines that have turned silver into a strategic asset that China now refuses to export. The inflation reading that's supposed to be bearish for silver is, in reality, a confirmation of every bullish thesis the metal has going for it. To understand why this matters, and why the next 60 days could redefine silver's role in the global financial system, we need to pull apart three layers that Wall Street is deliberately conflating. And the first layer starts with a man named Kevin Warsh and a phone call that changed everything. January 29th, 2026, silver hits $121 an ounce, gold touches $5,595. Copper spikes past $14,500 a ton. Across every metals trading desk in London, New York, and Shanghai, the word being used is the same, parabolic. For weeks, a wave of speculative capital, much of it flowing from Chinese retail investors through vehicles like the UBS SDIC Silver Futures Fund, had been pushing prices beyond anything the fundamentals alone could justify. The fund was trading at a 36% premium over its net asset value. Shanghai authorities had already halted trading once on January 22nd. It wasn't enough. The momentum was self-reinforcing. Then Trump made two moves in rapid succession. First, he said the struggling dollar was doing great, a comment that triggered another round of frenzied metals buying. Then, hours later, Bloomberg reported his intention to nominate Kevin Warsh as the next Federal Reserve chairman. The reaction was instantaneous. The dollar reversed hard, and precious metals went into freefall. Understanding Warsh is essential to understanding what happened next and what's about to happen. He served on the Federal Reserve Board from 2006 to 2011, a period that included the worst financial crisis since the Great Depression. He emerged from that era not as a defender of the Fed, but as one of its sharpest critics. He's publicly argued for a smaller Fed balance sheet, less intervention in markets, and a more disciplined approach to monetary policy. Wall Street interpreted his nomination as a signal. The era of easy money might actually end. The dollar's rally on that interpretation was the fastest precious metals liquidation trigger in modern history. But here's the layer most analysts are skipping. Warsh isn't simply a hawk. He's recently aligned himself with Trump's view that the Fed has been too slow to cut rates, arguing that AI-driven productivity growth is suppressing inflation more than the Fed acknowledges. The Bahnsen Group's analysis puts it clearly. Markets currently price 2 to 3 rate cuts by year-end, bringing the federal funds rate from its current 3.5 to 3.75 range down to around 2.75. The expectation, even with Warsh, is that rates come down, just not as fast as the speculative frenzy was betting on. If this kind of analysis is connecting dots you haven't seen elsewhere, subscribe and hit like, because what comes next is the part that changes the entire equation. The inflation print everyone is panicking about isn't the threat, it's the symptom, and the disease is something far more structural. While the entire financial world fixated on Kevin Warsh's name and the CPI number flashing across Bloomberg terminals, Something was happening inside the physical silver market that makes both of those stories look like distractions. The COMEX, the primary exchange where silver futures are traded and, crucially, where physical silver is supposed to be available for delivery, is bleeding metal at a rate that has no historical precedent. The numbers are stark. Registered silver inventory, that's the metal actually available to fulfill delivery contracts, has collapsed from 100 and 67.7 million ounces in October 2025 to approximately 103 million ounces as of early February. That's a 38% drawdown in 4 months. In a single week of January 2026, 33 million ounces were physically withdrawn. That's 26% of registered inventory gone in 7 days. JP Morgan issued, meaning delivered, 99% of those warrants. Now layer on the delivery behavior. January is historically a minor delivery month. Typical January deliveries in previous years range from 1 to 5 million ounces. January 2026 delivered 49.4 million ounces, 7.27 times January 2025. February's numbers are even more alarming. As of early February, 18.72 million ounces had been called for delivery from an open interest of 19.11 million ounces. That's a 98% delivery rate. This is not a futures market functioning as a hedging mechanism. This is a physical allocation machine running at maximum extraction, and the lease rates confirm it. Silver leasing, the mechanism by which institutions lend physical metal for a yield, typically carries a rate of 0.3 to 0.5%. By January 2026, the 1-month silver lease rate had exploded to 8%. When someone is willing to pay 8% annualized just to borrow silver for short-term delivery, the message is unambiguous. Physical supply and demand are violently out of balance. Here's why the CPI connection matters more than anyone is admitting. The industrial demand driving silver's structural deficit isn't discretionary. Solar panel manufacturing, electric vehicle production, 5G infrastructure, AI data center construction, these sectors don't stop buying silver because the price went from $32 to $84. Their demand is largely price inelastic. The Silver Institute estimates the annual supply deficit now exceeds 200 million ounces. China, the world's largest refiner and a critical supplier, reclassified silver as a strategic material on January 1st, 2026, and imposed export restrictions. That single policy decision fractured the global supply chain in a way that no Federal Reserve chairman, hawkish or dovish, can reverse. The crash wasn't the story. The crash was the cover. And what it's covering is a delivery crisis that's accelerating toward March. So let's connect every thread. The CPI comes in hot at 2.9%. Wall Street says, inflation rising, Fed stays hawkish, dollar strengthens, silver dies. That's the surface logic. Now here's the structural logic underneath it. The inflation is rising because energy and food costs are climbing. Energy costs are climbing because global electrification is accelerating. Electrification requires silver in every solar panel, every EV charging connector, every high conductivity component in AI server farms. Food costs are climbing because supply chains are fracturing along the same geopolitical lines that have turned silver into a contested strategic resource. The CPI number isn't bearish for silver's fundamentals. It's a direct measurement of the forces making silver indispensable. Now add the Warsh variable. Treasury Secretary Scott Bessent went on television on February 8th and attributed the January crash to Chinese speculators, calling it a speculative blow-off. He specifically named the UBS SDIC fund and its 36% premium. His framing was deliberate. This was irrational exuberance, not a fundamental repricing. But Bessent left out the other half of the equation. The same Chinese investors who drove the speculative spike were responding to something real. Their own government classifying silver as a strategic asset and restricting its export. When a nation of 1.4 billion people is told by its own regulators that silver is too important to let leave the country, the buying response isn't irrational, it's logical. The crash cleared out the leveraged speculators. It purged the margin accounts. It reset the options chain. But it did not change a single structural parameter. COMEX registered inventory is still at 103 million ounces. March open interest still represents 400 to 500 million ounces of notional delivery obligations. The lease rate is still multiples above historical norms. The annual supply deficit is still north of 200 million ounces. And China's export ban is still in effect. Here's the question. No one in mainstream financial coverage is willing to ask. If the January crash was supposed to relieve delivery pressure on COMEX, why is February's delivery rate running at 98%? Why are buyers still converting futures contracts into physical metal at a pace that treats the exchange not as a hedging platform, but as a last resort supply depot? And what happens in March COMEX's primary delivery month, when that remaining 103 million ounces of registered silver faces delivery demand that could exceed 70 million ounces under conservative assumptions. I genuinely want to know where you land on this. Drop your analysis in the comments. Some of the sharpest thinking on this channel comes from this community. The convergence point is approaching, and it has nothing to do with what the CPI says next month. Let's pull back and see the full architecture. You have an inflation reading that confirms the acceleration of the exact industrial forces that consume silver. You have a new Federal Reserve chairman whose appointment triggered the largest single-day silver crash since 1980, but whose actual policy stance suggests rate cuts are still coming, just on a slower timeline. You have a physical delivery system that's hemorrhaging metal at 7 times historical rates. You have China walling off its silver supply. And you have a market price sitting at $84, 30% below its January peak, while every structural indicator points in one direction. This is the gap between what the price is telling you right now and what the physical market is telling you right now. And historically, when paper prices and physical reality diverge this dramatically, the resolution is never gradual. It's sudden, it's violent, and it reprices everything. The popular narrative, the one being broadcast on every financial network today, says silver overheated, the crash was healthy, and the inflation data seals the case for a stronger dollar and weaker metals. That narrative is internally consistent. It makes sense if you only look at the price chart in the CPI print. But it requires you to ignore the COMEX vault data. It requires you to ignore the lease rates. It requires you to ignore China's strategic reclassification. It requires you to ignore the 98% February delivery rate. It requires you to ignore the 200 million ounce annual supply deficit. That's a lot of ignoring. What's within your control is this: understanding the difference between a price and a value. The price of silver is $84 because leveraged speculators were forced to liquidate. The value of silver, its role in electrification, its scarcity relative to industrial demand, its emerging status as a strategic asset in great power competition, that hasn't changed. If anything, yesterday's CPI number confirmed it. Remember where we started, 2.9%, a single number that the market interpreted as a death sentence for silver. But numbers don't have meaning in isolation. They have meaning in context. And the context surrounding silver right now, the inventory drawdowns, the delivery acceleration, the export restrictions, the structural deficit, transforms that 2.9% from a bearish signal into something else entirely. A confirmation that the world is consuming silver faster than it can produce it, and no interest rate decision on Earth changes that equation. The inflation isn't killing silver. The inflation is silver's thesis, written in government data, published for everyone to see. The only question is whether you read it before the market reprices to match reality.